Hello, everyone, and welcome to MCAEC's Empower Me series. I'm Melvin Sequeira from the Social Activities Committee, and I'm your session moderator today. Today's session is for beginners who want to learn stock market investing and the fundamentals of trading. There are many of us who do not have any idea about stock market. There are so many who are afraid of investing in stock market and the risks involved, including me. Nobody starts out as an expert, or even the best investors in the world were once sitting where you and me are. So, all parents who are watching this webinar, we encourage your kids to join as well. The information provided in the session is for educational purposes only and should not be considered as an investment advice. Neither the speakers nor MCAEC owns any liability now or in future. At the end of the session, we have an investment mock game, the participation for which is voluntary and for educational purposes. There is no real money involved, and we have used a third-party software to simulate the game. I now take great pleasure to introduce our two speakers, Mark Mendonça and Kevin DeCosta. Mark Mendonça is working as a director, enterprise transformation at a global consulting company, providing specialized advisory services to Fortune 500 companies. He is a seasoned IT professional with 25 years of experience in leading and transforming IT organizations. As Stretch Objective, Mark leads large employee resource groups of nearly 1,500 employees and has received an award from the CEO for leveraging the power of diversity and inclusion. He has also served as president and area governor of Toastmasters International and received Distinguished Toastmasters Award. Last but not the least, he is the founding member of MCAEC. He has led the organization twice as president and has been instrumental in crafting a vision for MCAEC. Mark has a BE in computer science and MBA from Rutgers Business School. He lives in Edison with his wife Merlin and two children, Meldon and Melanie. Today, Mark has volunteered to share some of his experiences with his fellow MCAEC members. Kevin is one of the original founding members of MCAEC and served on the first executive board of MCAEC. He was born and brought up in Mumbai and currently lives in Edison with his wife Priya and daughter Nikki. Kevin has a degree in computer science and works for a top-tier management consulting firm in New York City. In his spare time, you will find him either gardening, cooking, doing home improvements, or fishing on his boat. He is passionate about investments and keeps himself updated on various financial trends in the industry. If you have any questions during the session, you can post in the chat window. Our speakers will answer the question at the end of the session. I now invite Mark to take over the session. Let the learning begin.
Thank you, Melvin, for that wonderful introduction, and thank you, Kevin, for joining me. This is Mark Mendonça. I want to begin with a small story that I've read somewhere. An investment banker was vacationing in a small town or a village in Mexico on a beach. And he has been approached by a fisherman who had catch of his day for the day. And the banker asks, how long did it take for you to catch this fish? He said, a little while. So he said, what do you do rest of the day? The fisherman said, oh, I sell the fish and then go home, have a siesta with my wife, play with my kids, and hang out with my buddies in the evening, and probably have a drink, and then have life goes on. So the investment banker says, I have MBA from Harvard, and I have a great idea for you. You should go and catch a little bit more fish. And then the fisherman says, what do I do with that? He said, you will do more money. And then do what? Then you will buy an additional boat. You'll buy a boat. And then do what? Then you buy more boats, and you probably have a fleet of boats. And then what? The fisherman says. Then, you will open an industry. Instead of selling this fish to a middleman, you can just talk to the wholesalers and make more money. And then what? The fisherman said, then you should go to New York City and your company is so established, you should sell stocks, and people will buy stocks and make more money. And then what the fisherman says, for that the investment banker says, once you have a lot of stocks and money, you can come back to this village and relax. You can catch little fish, and maybe uh, you can go and have a siesta with your wife and play with your kids and hang out with the buddies. So for that, the fisherman says, "Isn't that what I'm doing already?" Yes, uh, that is the story that was told, and probably you have heard many times. But unfortunately, we are neither the fisherman nor the investment banker who is, having fun at the beach or relaxing. We are somewhere in between. Most of us are in between, right? We have our daily expenses, we have our medical bills to pay, we have our children's education funding, we have to pay for retirement, we have to have our vacation travel and all mortgage to pay and things like that. So we are in between. So the little money that we earn through our wages or the salaries may not be enough, or if you just keep it in the bank and get a little interest. If you look at it, most of the successful, wealthiest people have some form of investment in stocks. If you look at Warren Buffett, he's one of the richest men in the world. He started investing in stocks. In fact, he bought his first stock at the age of 11, and I think he invested like $36 per share on a oil company. So wealthy people have invested in stocks, and this today our session is for people like our children, our teenagers. Other day, daughter came to my I was trying to do a trading. My daughter came to my room and said, "Dad, what is that? Can I teach a little bit? Can you teach me how to do stock trading?" My wife, she has never traded a stock in her life, and she wants to know how to do that. So I met so many people, and so many people asking same questions. Can you help us give some basic education? Because many people are scared of stocks because of the downturn. So today, our audience is primarily for children or teenagers who have never done or who wants to learn stock market basics, basics of investing, and adults who have never done stock trading. If you have already invested stocks, uh, this could be you can join in the game at the end of the session and play and see how well you stand among others. So at the end of the session, we'll have a game. Kevin will provide the details about it, and we'll have a winner. So with that, I want to start off with my slides that we have here. Melvin already gave. Melvin, can you see the slides?
No, not yet.
Okay, one second. Just give me when you can see this. Present to everyone. You should be able to see it now.
Yeah, it's just getting a little better. Yeah,
Can you see it?
yeah. Yes,
Okay.
it's visible.
Stop me if you cannot see or cannot hear. Okay. Let me start there. All right. Um, so let me start with today's topic. I want to talk about three things: why, what, and how. And the next 20 minutes will just cover these topics. So why is so important to invest in stock market? That's a business case, right? If you want to say it's a business case, why you want to do this? What in this section we'll talk about what is the stock market, what is the stock, how to do trading and things like that. And finally, how you want to go about it, right? Creating your own portfolio and playing the game. So that's how this presentation is organized. And as we go through this, on the right hand side top of the screen, you will know where we are. For example, now we are talking about why. Now think about today. You're buying a candy for $1, right? Tomorrow, or maybe sometime in the future, it costs $2 to buy the same candy. Now, which means if your $1 doesn't become $2 tomorrow, you cannot buy that candy. We call that as inflation, right? If your $1 doesn't become $2 by tomorrow, whenever you buy that, you have a diminishing buying power. Your money has to grow faster than or at least become $2 when you buy the candy in the future. So that's inflation. Now, what is growth? Let's say you buy, in our, if you look at the lifespan, first 20 years, we are, learning, or we are students or educating. After that, next 40 years will be in earning or salary or whatever it is. But after that is retirement. So your money has to not only grow to buy whatever it costs for tomorrow or in the future, you need to have much more, because during the time of your retirement, you need to have money to buy what you want to buy or to maintain a lifestyle. So that's the business case. So you have to have money, or you have to have money growing faster than the inflation. You need to have a growth. You need to have a sustainable income in the future for your retirement to maintain your lifestyle. Now, so what do I do now? You have your hard-earned money. You need to invest that wisely. You need to have a rate of return or return on investment above the inflation. If you look at that right chart, the red line, if it is the inflation, you need to have earned, with that white line, you need to have a rate of return more than the inflation. If your money should grow faster, look at those two girls who are growing hair. One of the hair, both of them probably started same, but one of them had a better formula maybe for the growth, and she has grown much lengthier hair or healthier hair compared to the other girl. So I just got this quote: a long term investment is a short term investment that failed. And many of you remember that during Y2K, we all made some short term investment, and we lived with that memory and became a long term investment, including me. So this is the what. Now, if you have to see, how do I go about investing it? So despite market risk or stock market risk, right, that we have, stock markets have historically, uh, given return substantially higher based on the history, right? If you look at the chart on the right, I think I got this from internet. The last 50 years, S&P 500, which is the 500 companies part of the S&P, in 1950 to 2016, a dollar invested, I think, it's became $2,500 or something like that. So where do you get this kind of return if you put this in the bank with, let's say, today's interest rate less than 1%? Some banks give you 1.5%. You will never reach there, and I'll give you an example later. Even though there are some, downward trends, as you can see, but overall, the stock market has done much more better than uh, the average other forms of investment. And you need to have a well-balanced portfolio with the right risk threshold, and we'll explain what that is later, in order to have a financial well-being. Today, we're talking about creating a simple portfolio. Kevin will talk about it later. And what we're trying to give here is our education purpose only, and it's not an investment advice. A typical portfolio, Kevin will talk about, which consists of different kinds of instruments, something like that you can see on the right-hand side in a pie chart. Okay, so let's start with the basics. What is a stock? It's a stock is a portion of a ownership in a company, right? So it's a way of raising money for the company. If your company wants to start a business, right, they need money. They will sell what is called stocks or shares, and you will buy shares and stocks, and that's how company makes money and go about with their business. So why we need to? So in order to explain this a little better, I have a funny video here. I can just show it to you in a minute. It takes just a minute to show this. Hopefully you can see this.
Hey guys.
Melody Hobson, what's poppin', babe?
Why don't you start by telling me what is a stock? Behind the scenes.
Stock is a share in a company.
Yeah, a stock is a share in a company.
Glad that's cleared up. You buy a stock in a company, and that it pretty much means you're part owner of it.
I think you look so pretty. Big brown eyes. You know, I wore the sweater vest for you. Do you like it?
You don't have to answer that.
Okay, let's move on. How about bonds?
Buying a corporate bond means you're loaning a company money for a certain amount of time. It's kind of like a fancy IOU.
Sweet melody, oh harmony.
No.
You're like a dolphin to me. My love will set you free. And then,
Hey, girl, can I hit you back? No, well, you can't find them because they're not in season right now. Just squeeze them.
all right, call you back.
Sorry about that. You were saying?
Well, hopefully you could see that video. If not, I can send you the link, which is here. You can see it later. So what is the stock? I think you understood why we buy stocks. There are two reasons why we buy stocks, right? When you put money in your bank, they give you what is called interest.
A lot of people are like, aren't you too young to invest in the markets? And, don't worry about it. I just look young.
Sorry. So you buy stocks for two reasons, right? Like in bank, they give you rate of interest based on the interest rate on a periodic basis that you will use it for your income. Stocks give what is called a dividend. This is called corporate dividend because it's a profit that the company gives to shareholders. Typically, they do every quarter. Some companies do every year. Also, you have what is called a capital gain. To give an example, let's say you buy Amazon for $1,000 and then you sell for $1,500. You made a profit or a capital gain of $500 per share. That's capital gain. These are the two reasons why people buy stocks. Now, where do you buy stocks? Typically, you buy in the stock market. What you see is a picture of NYSE, New York Stock Exchange. It looks more chaotic, right? It's a trading flow that we can see. So if you have commodities, let's say you grow vegetables at home, or in my previous example about fish, you go to the market to buy something, right? Here, to buy stocks, you have to go to stock market. In US, we have two big ones: New York Stock Exchange and Nasdaq. New York Stock Exchange, also known as Wall Street. Many of you heard about, and Nasdaq, I think, is in Chicago. So we use brokers since we cannot go into the market, the trading floor. We use brokers such as Fidelity or Vanguard to buy stocks. Now, how do you buy stocks? Many of you bought items from or products from stores where they scan what we have called UPC, right? They scan the UPC and they know which product it is, how much it costs. Similarly, to buy a company stock, what you have is called ticker symbol. So through the ticker symbol, you will buy the stock. For example, the ticker symbols here is Amazon, AMZN, Microsoft, MSFT, Google, Walmart, GE, Merck, PayPal. These are the ticker symbols. You need to know these ticker symbols to buy a stock. Typically, they are one-letter word or up to 5 letters word that I've seen for some of the mutual funds and some of the companies. Also, you need to know at what price you want to buy, right, or sell it. You need to know what you want to buy, and also you want to know at what price you want to buy. And remember, the stock price changes every single moment during the entire trading time. You need to have action whether you want to buy or sell. And then the order type, which is market order, limit order. Market order means it executes immediately. Usually, the stockbrokers, they execute this within the 30 seconds after you say yes, buy or sell. Limit order means, you set a limit that the trade should execute only at a certain price. Now, let's say the example of the right-hand side. We are buying Netflix, right? At what currently the price is $108.86. It's up $4.06 today, which is 3.87%. Right? It opened at 108. DSI is 108.99. You can say market order, which means it executes immediately. If the price is 108.86, next bid price, it'll execute. Alternately, you can say limit order, say that, hey, only if the price goes 106 or below, I want that stock. So that's the limit order. Now, there is a quote here. Here. The market is weird, right? Every time one guy sells, another one buys, and they both think they're smart. So I thought it was a funny quote, and I thought I'll put it here. Now, how do you submit an order? Order is something like, a trade, which means whether you buy or sell. Now let's think about it. We are buying Microsoft. Currently, trades at 89.60 based on the screenshot here. The current price could be different. I got this about a month back. So we are saying here on the right hand side, we are buying Microsoft. MSFT is the ticker symbol. Action is buy, and the order type here is a limit order. I'm saying quantity is 100, and the limit price is 88. At the bottom, I'm saying time in force is day. That means, and the order execution is 4 p.m. What happens is, any time during the day, if the price goes 88 or below, until 4 p.m. that day, my trade gets executed. That's how we submit an order. So then you can do the same thing with the sell order. Action will be sell, and you can put a sell price, how much you want to sell, the quantity, and the ticker symbol you need to put, and the period by which it needs to be executed. You can put a day order, which means execute anytime during the day, or good till cancel, usually 6 months. The most of the broker give you a preview order. That means once you see everything is good, you can give a final submit button. All right. How do you calculate profit or capital gains? We talked about capital gains. Now think about this situation. Microsoft, we bought 100 shares on January 16, 2017 at a price of $62.74 per share. The cost of 100 share will be multiplied by 100, 6,274. Usually there's a broker fee, let's say $5. So your cost is 6,279, right? Because $5 added to the cost. Now you sold those 1 year later in 2018, January 15, at 89.60. That was the price. You sold 100 shares, becomes 89.60, and you have to pay a $5 fee because broker will charge you a fee when you buy as well as when you sell. The difference between the sell price, that is 8955 minus 6279, which is 2676, is your profit or capital gain. In other words, you made in a year 42.61%. Compare this with the bank, which typically gives 1%. If you had invested this in bank, you would have made probably $62 on a $6,200 investment, right? At 1%. Here you're making 42% profit or 2,676. Now, what is capital loss? Think about GE, where I bought 100 shares at $30.57 on January 16th. My cost was $3,053 with a trading fee of $5 with broker charges. So total cost is $3,058. Then I sold this 1 year later at the share price was $18.76. So for 100 shares that I bought, I sold at $18.76. The difference is $1187. So I made a loss because I sold low, buy high. And my return investment is negative 38%. So the big question is, did everyone who bought and sold Microsoft make a profit? Did everyone who bought and sold GE suffer a loss? The answer is no. Here is why. As you can see the stock market chart, there are always peaks and valleys. You buy at the valley and sell at the peak, then you make a profit. So same thing, the peaks and values are there in GE. Depends on when you buy it, at what price, and when you sell it, determines whether you make a profit or loss. So it's very important to understand when to buy and when to sell. But most of us do not know when to buy or when to sell. So what you do, what is called a dollar cost average, because no one can predict the stock price, when it moves, when it goes up or down. So let's say I have an investment to make. So what is the dollar cost averaging? Let's say I want to invest $4,000 for a year. We are buying HDFC Bank here. Quarter one, I bought $1,000 worth of stock. The price was 64.21. So which means I got only 15 stocks, right? 15.57 stocks. 1,000 divided by 64.21. Next quarter, the price was 76.52 because the stock price changes. I've still invested $1,000, but I got less number of stocks. This time only 13. Quarter three, I still invested $1,000, but the price was different. So number of stocks are less. So and so forth. At the year end, I invested $4,000. I got a total number of stocks of $50 and 50 stocks and 50.71 stocks. So on average, the price of each stock is 78.87. Now today the price of HDFC is about $96. If I sell it, I would have made a profit 96 minus 78 times whatever the number of shares, which is 50. That would have been my capital gain. Okay, moving on. As you say, some companies make profit, some companies make loss, depending on where you stand when you buy. So you can buy a basket of stocks instead of one stock, which is called exchange traded funds. There's a basket of stocks, just like S&P 500. We can buy the stocks in bulk. There could be, you buy one ticker symbol. Let's say you have a ticker symbol called VTI, Vanguard Total Index, which has about 2,500 stocks. So you buy that one ticker symbol, which represents a basket full of stocks, and that way you can you don't have to worry about which company does what, right? Overall, if you get a gain, that will be good for you. Some of the ETFs here, large caps, which means the market capitalization, I believe, is 5 billion and up. I believe it's a mid cap, and then small cap. There are some international ETFs, and then sector-specific ETFs. For example, if you think that in a rising interest rate, financial stocks are doing good, you probably buy a financial ETF. This would probably have, let's say, Visa, MasterCard from the banks and financial institutions. Or you may buy healthcare stocks, right? If you think the healthcare is doing good. Or IT stocks, if you think Amazon and Google and all those companies are doing good in the long run. Or REIT, if you think property prices are increasing and companies who are, real estate is doing very well, so you can buy that. Or energy stocks, if the oil price is increasing. If you have a view on a market, on a particular sector, you can buy those stocks. Or you can buy something like VTI, which I said here, Total Stock Market Index, which represents, I think, 2,500 stocks in the entire market, or maybe more, I don't know. All right, I want to stop here and hand over to Kevin, who will be talking about a portfolio of investment.
Awesome. So Mark talked about why invest and how to invest, and I will talk about where to invest. So as you think about investment, right, you want to create a portfolio. A portfolio is nothing but a set of investments that you invest your money in. Depending on your age, your risk appetite, and your investment duration, you want to think about what your ratio is for stocks versus bonds versus cash. Let's say you're starting at a very young age and you have a very high risk appetite, which means you're okay with a fluctuation in your portfolio of 30-40% because you're in it for the long term. So you would typically have a large number of stocks in your portfolio as compared to bonds or cash. Whereas if you're closer to your retiring age, you would want to kind of reduce your risks with the fluctuation of stock market. You want to be heavy on bonds and reduce your exposure to stocks. So there are various formulas. There are various asset allocation ratios for different age groups. You can read it up. But typically, for most people, starting investments, you go heavy on stocks and you go light on bonds, and you have some cash for emergencies. So there are, on the slide there is 3 portfolios with a certain ratio. Conservative being you're very conservative about your portfolio. You don't like to have very high fluctuations with the market going up or down. So you're kind of low on stocks, whereas bonds are 50% or maybe even more. And then there's moderate portfolio. You're in a moderate risk taker. And then an aggressive portfolio where you go with 70% stocks. And these stocks, as Mark mentioned, could be an index fund like a VTI, which is a total US market index fund, or a total international index fund. It could be any, you could take a basket of stocks. Typically, you don't want to invest in one stock, right? Because the risk is too high, right? You don't want to put all your eggs in one basket. What you typically want to do is buy a set of stocks that give you a good exposure and kind of reduce your risks. You can buy some IT stocks, some banking stocks, some healthcare stocks, or you can buy an index. An index gives you exposure to 500 plus stocks in a particular stock market index, and that way you kind of diversify your risks, right? And Mark also talked about dollar cost averaging, which means you don't invest in one go, right? You invest over a period of time, whether it's a month, a week, every other day, right? So you kind of reduce your risks. So that's, I think, Mark, if we can go to the next slide. So what we've done is, as we mentioned earlier, we have created a game for all of you. This is primarily because we've heard from a lot of people that, I've never invested in stocks or bonds. I don't know how to invest, and I'm scared of losing money, right? So people have that phobia that what if I don't know what I'm doing? So to, kind of elevate people from that phobia, we've created this game, which is you get $100,000 of play money, which is not real money, and you can choose to invest. You get a hang of it. You get an experience of how to invest money in the stock market, and then you get to see how that money grows, right? How it changes over time. So if the stock market goes up, you will see appreciation. If the stock market goes down, you will see decrease in your portfolio. So it's for kids. It's for adults who've never invested in the market. It also gives you a good idea of how everyone else is investing. So when I do the demo, I'll show you, we have a few folks who have already signed up, and you'll see how people are investing and how their portfolio has appreciated, or there's losses in their portfolio. So with that said, I think we can quickly, so yeah, one other thing is to participate in this game, you would need to send an email to info@mca-ec.com before March 17th, 8 p.m. And then we will give you the link to the game and the password to participate. So kindly remember that. Yeah. So I will quickly share my screen, and I hope you guys. Melvin, can you confirm if you can see my screen?
Not yet, Kevin. Lancy will have to, I think, stop sharing. Yeah.
I did.
Can you see my screen now?
Yeah, we can see.
Okay. So here's how the game looks. So we have 4 people already who have joined, and we started the game a couple of days back. So you will see a few investments that people have already made. I will quickly go to my investments. If you see, I have not fully invested my $100,000, but I still have $44,700 in cash remaining, which I can buy stocks. But my portfolio has appreciated by $2,420 already, right, in the last couple of days. And as you can see, I have invested in a REIT, in GE, in an index fund. It's a total stock market index, and this is a total international stock market index. So I'm basically buying shares via an index fund. And if once you join the game, you can, it's as simple as just typing in the name of the company you want to invest in, and then just trade. And then you can choose how many shares you want to buy, and then what price you want to buy it at, and then you can submit the order. It's as simple as that. This game essentially gives you, you can learn from others as to and look at what people are investing in. Priya is here with her portfolio. She has bought Apple, Netflix, Salesforce, GE, Google, Costco, Microsoft, Facebook. So you can see what others are investing in and learn from them, right? And see where they stand. You'll get to see patterns. You'll understand how people are investing, and it'll be fun. I think people will learn a lot. I think all the kids will get to experience how to invest and where to invest, and each one can learn from each other's research, what they are finding about the stock market, which stocks to invest in, which index funds. At least it'll bring up the awareness among our MCA community. I think with that said, I think we can open up for questions.
You can stop sharing, Kevin.
I will do that.
Yeah, so far we have only one question. It is, which broker house has least transaction fees?
It depends. There are different brokers with different transaction fees. Some of them, if you are able to bring in a certain amount of money, then they will reduce your transaction fees, or they may even give you the first 25. I know Vanguard, if you have a $250,000, will give you at least 25 transactions for free, I think. But each broker has their own, kind of incentives on transaction fees.
Yeah, just to add to that, what Kevin said, I think these days a lot of people are using an app called Robinhood, I think, which has no transaction fee. Is it Robinhood? Kevin, is it Robinhood? Or?
Yeah, there is Robinhood. I have not used it personally.
Yeah. I've seen people using it, and people told me that there's no transaction fee on that.
Right.
Okay, our next question is, what's a good trading platform to invest?
What's a good trading platform to invest? I don't know I don't think I understood the question.
Yeah, I also didn't understand the question. So if you can maybe elaborate a little bit further.
Okay, meanwhile, maybe we can go to the next question. Can you name some of the broker houses?
So there's Fidelity, there's Bank of America, there is Vanguard, there is E-Trade, there is Capital One Investing, there's Robinhood, as Mark mentioned. There are many brokerage houses.
And each of these brokerage houses, they have their fee, and depending on what type of client you are, the fee structure changes. For example, if you have $250,000 with Fidelity, they will charge you, I think, $495. Otherwise, it'll be $795, I believe. Whereas Vanguard, I think, if you have $500,000 with them, they will charge you $2 instead of $7, I think. And then similarly, they may have different fee structure depending on how much money you have. As Kevin mentioned, some of the broker, just for starting, they have some free trades. I think sometime back Fidelity had 100 shares free or something, 100 trades free or something like that. So there are always promotions that you can look out.
Also keep in mind, if you're primarily going to invest in index funds, let's say you want to buy Vanguard index funds, Vanguard will not charge you any commission or trading charges for that. Those are free. So you may want to open a account with Vanguard if you're going to buy Vanguard funds. Similarly is the case with Fidelity. If you're going to invest in Fidelity funds, they are free to buy through Fidelity or any other, Capital One, etc. So you can buy their own funds, and that way you don't pay the transaction fees.
So just to see here, if you see on the right hand side here, right, anything that you start with V are Vanguard funds. For example, VNQ, VAW, all this. Any of these are all Vanguard funds. Anything you start with V, mostly, and they have no transaction fee. They're all Vanguard funds.
Right. One other piece of advice is, your investment advisor or any other advisor might try to push you to buy certain index funds or certain other actively managed funds. You want to look at the expense ratio or the front load for those funds before you invest in it, and compare it to some of the other comparable index funds. For example, Vanguard, as per my research, has some of the lowest expense ratios of any fund house. So you want to kind of go into funds or invest in funds which have the lowest expense ratio, because at the end of the day, the $100 you put in a fund, right? You want maximum of that money to be invested in that fund, not pay out of the $100, $10 to the fund house for managing that fund, right? Then you're basically investing $90, not $100, right? So think about those aspects as you invest. Do not look at just the performance of the fund, but also compare the expense ratios and the front end load if there's any.
The next question is, what's a typical transaction fee?
Something like $5.99 or $7.99 is what I've seen. If you're paying maybe more than that, then I think it's too high.
Is there a minimum amount that you need to put during investment?
There is no minimum amount. You can start with one stock, or you can start with for some of the index funds, if you're buying ETFs, there's no minimum amount. But if you're buying a mutual fund, then they typically have a 3,000 minimum, or depending on the fund, or a 10,000 minimum. My experience has primarily been with Vanguard, where for any kind of mutual fund, they start with 3,000 as the minimum, and then for an Admiral fund, they go up with a minimum of 10,000. But if you're buying stock, you can buy one stock to start with. There's nothing stopping you from buying one stock of a company.
Also, just to add, for mutual funds, right, once you have that initial investment, let's say Fidelity charges most of the funds $2,500 minimum, and Vanguard at 3,000, right? Once you have that minimum amount, for every month, let's say every week or every fortnight, you want to add more money to that, what is called automatic investment, they won't charge you any transaction fee. Actually, mutual funds, most of the mutual funds do not have any transaction fee. But doing a systematic investment or dollar cost averaging, in fact, what I do is Vanguard takes a certain amount of money every week from my bank and invest in the choice of mutual funds that I have already with them. They put into, let's say, $100 here, $200 here, things like that. Let's say I want to invest $1,000 every week, and say $100 put into this fund, $200 put into this fund, and so forth. They do that automatically, taking money from my bank and no charges.
Okay, the next question is, my company uses Vanguard for 401k. Can we use the same logins to invest personal investments?
You may want to check with your company, depending on the arrangement they have. You may be able to do it, or may have to create a personal account with Vanguard.
Yeah, I had this experience. I had Fidelity from my previous company, as well as a new company, and I have my personal account with them. So the same account, I could see all three. With the same login, I could see all three accounts.
Okay, the next question is, can you tell on Vanguard Admiral funds versus the other of Vanguard funds?
So Admiral is one of their lowest cost funds. The expense ratio is very, very low. Typically, you need to have $10,000 or more to invest in those funds. And my preference has been to go with Admiral funds because of the low expense ratio. But you can start with a regular fund with 3,000, and then once you start investing, and over a period of time, once you get to the 10,000 level, they will automatically let you convert from your regular fund to the Admiral fund. There's an option on the screen which lets you convert without any charge.
If a person is on an H-1B visa, can he still invest, or he needs to be a citizen?
Absolutely. There is no rule for H-1B visas to not invest. You can certainly invest in the stock market.
I think there are some restrictions for Indian citizens, I guess, living in US and Canada to invest in India. There are some restrictions, but not vice versa, right? If you're investing in India, there is no. If you're investing in US, I don't think there is any restrictions.
Right.
We can even buy stocks from Indian companies, like say ICICI Bank, HDFC Bank, and Tata, and things like that.
We are done with the questions so far.
Okay, so we have few minutes left. If anybody has any questions, they can continue. So we just wanted to summarize a few things. If you want to be part of this game, please send an email. The email is there in info@mca-ec.com. You can see on the screen. Put a subject as Investment Game 2018 with your name in the body of the email. And you have to do this before next Saturday so that we can communicate only to those people who will be participating in the game. As Kevin said, it will be a very interesting game. We can learn from each other where people are investing and take those steps to real life. Um, so I may not be knowing some companies which I want to invest, and people are doing really good. They have insights about the companies. Maybe I can take this to real life and start investing and make money, right? That's other benefit of doing this, and also see how people are investing, where they're investing, how they're buying and selling. There are some people, if every day you can see who is in the top in the leaderboard there, and then what they do, what strategies they use. Um, you can do that. Another thing I want to say in this forum is that so this is a monthly series that we have, what we call Empower Me series. We talk about, we get top speakers from different topics. This has been an investment basic topic, but last month we had international tax. And then we have next month someone talking about mental health. So we'll have our topics range from financial well-being, health and fitness, home and family, career planning, transition to college, technology, leadership, communication, inspirational, motivation speech, so on and so forth. If any of you have, if you know speakers who want to participate and be a speaker, please send an email to info@mca-ec.com. I know everybody is, has some skill set that other people can benefit from, and it just takes sitting at home and then talking for about 40 minutes or so. It need not be just one person. You can have two or three people join together and provide the perspective, which is what we have done. We also had a panel discussion. Four of us talked about specifically our experience and share in investing. We hit upon different topics. Kevin was one of the participants. There are two other people. That's there in MCA. If you go to Google or YouTube and Google for MCAC Empower Me series, you will probably find that. So we have been talking on different subjects. We started this about 2 years back, and we look for speakers. If you have any speakers, if you want to volunteer, please send an email to info@mca-ec.com. Lastly, just wanted to summarize the talk. Investment in stock has historically performed better than most other investment forms. I think you've seen that the chart, how stock market, despite some risk downturns, overall it has proven to be a very successful investment vehicle. What is important is the time horizon, which is a major factor. How long you want to keep investing, right? If you want to make, if you want money, let's say 1 year from now, it may be risky. But if your time horizon is, let's say, 15 years, 20 years, uh, stock market investment probably is the right choice. You need to have diversification, as Kevin said. If you just cannot put all eggs in the same basket, you need to diversify, get different companies, get basket of stocks, have different forms of investment, stocks and bonds and mutual funds and things like that. Also, since we cannot time the market, make sure that you do dollar cost average, which is buying a certain amount of, making certain investment every week, every month, or every quarter, whatever you see, whatever seems to be appropriate to you. And finally, make an investment based on your risk tolerance. Some people lose sleep when they see the stock market goes 10% down. Right? You should not lose sleep. It's a paper loss, right? If you don't sell for next 15 years, it doesn't matter, right? So I think last month stock market went 10% down. It came back. I think those people didn't do anything. It came back. Those people take money out. They are at loss. It came back. I think almost like 8% back. Right? I think it's just 2 or 3% lower than all-time high. At least my portfolio. I can see that it's just 2% lower than all-time high. So I didn't take out money. In fact, that's a good opportunity for us to add to the portfolio. So if you fund, if you keep these things in mind, right, diversification, risk tolerance, time horizon, dollar cost averaging, and a sound investment plan with a good portfolio, I think it is a good investment. It has shown, history has shown that that's a good investment. We see, several billionaires or wealthy people in the world, they have some form of stock investment and they have become rich, including famous Warren Buffett. So with that, I want to conclude and transition back to you, Melrin, for closing.
Yeah, we have one more question. Do you get taxed on stocks?
Yes, you do. If you get dividends from those stocks or if you sell those stocks, you will definitely get taxed on it.
Yeah, again, it's country specific. I think in India, you don't have tax on dividend and also long-term capital gains. Long-term capital gains is when you keep the stock at least for a year, right? In US, there are two forms of taxes: short-term and long-term. If you buy and sell within a year, then there is a short-term gains, which means whatever you make will be added to your income for the year, and you will pay taxes based on your tax bracket. If you, I think, keep it more than a year, I think it's a flat 20%, I believe. Somebody has to correct it. I think it's a flat 20% tax, I believe, for long-term tax. It may have changed now. So there is a different tax bracket depending on the time horizon. And then there are other things you have to understand or remember is that tax harvesting. Let's say you made losses on one stock and made gains on some other stocks. You can sell those loss making, and you can, let's say you made 5,000 on one stock gain and 3,000 losses on another. So you can sell the 3,000. So your net gain is 2,000. You have to pay tax only on 2,000. They can allow you to take off that losses up to $3,000 per year. So there are some tax laws. We are not tax experts, but you should talk to a tax advisor. But this is what we are sharing our experience and what I do.
That's all we have from the question and answer round. Okay. I would also like everyone to give your names to info@mcaec.com before 17th March in order to participate in this investment game. So thanks a lot, Kevin and Mark. It was a great pleasure to have you today to share your wonderful experiences with us and to help fellow citizens to make the right choices and decisions in confusing situations of investing. This session will be available on YouTube by the link mentioned in the email. Also, you can type Social Activities Committee on YouTube and will find today's session there. All our previous sessions are also available on the YouTube link. Thank you, everybody, for joining this session. Thanks, Kevin, Mark.
Thank you.
Thank you, everyone, and have a good night.
Bye-bye.
Bye.